This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Back in our first lecture on partnerships, what we learnt, of course, was that it wasn't the partnership that was charged to tax, it was each partner. They were assessed on their share of the tax-adjusted trading profit of the accounting period. So the exercise that we must always do is take an accounting period's tax-adjusted trading profit and divide it between the partners according to the profit-sharing agreement, or more likely agreements, in force during that accounting period. Now, in the previous example, in our previous session, what we had was a change in the profit-sharing arrangements, but it was still the continuing partners A and V in the example that we had running. What we're now going to look at, and what we spoke of at the end of the previous session, was a rather more fundamental change so far as the partnership was concerned. And that was either a new partner joining the partnership, which will be the situation in this next example, or the possibility of an old partner leaving the partnership. Now, what we know is that for any continuing partners, once you've established their share of the profit for the accounting period, then they will be assessed using CYB. But any new partner joining the partnership, based on the date that they joined the partnership, that will be viewed to be their start date and therefore determine their first tax year of assessment. And then you must apply the normal rules, the bases of assessment that apply in opening years. Or if we had a partner leaving the partnership, then based on that date the partnership retired, left the partnership, that would be deemed as their cessation date. And therefore, we would need to work assessments for the final tax years using the closing years rules of assessment. Okay, let's see therefore how we now deal with that particular problem. The example that we see here continues our example from our first lecture together on partnerships, where we had partners A and V. What we're now told is, as we move on from what was the accounting year ended 31st of December 15 that we dealt with, to now the year ended 31st of December 16. And we're now told that on the 1st of July 2016, a new partner FC here, joins the partnership. And as a result, there was a new profit sharing agreement that was brought into force. We had salaries for each of the partners, which on an annual or per annum basis were £20,000 for A, £20,000 for V, and £10,000 for FC. We changed the profit sharing ratio then to 3 to 2 to 1 in order A to V to FC. Just pause now for due veneration of those initials, AVFC. Indeed, I don't have much of a life, do I? I'm an accountant and I support Aston Villa Football Club there. The greatest team the universe had ever known. We will rise again, be assured. But enough of my problems. Okay, let's just remind you now of, in our previous session, the example that we had, where the adjusted trading profit for the accounting year ended December 16 was £80,000. Now, you haven't got the example to hand, don't worry, £80,000. And assume that the adjusted trading profit for the accounting year ended December 17 is £100,000. So year ended December 16, the partnership tax-adjusted trading profit. Year ended December 16 is 80,000, and we'll assume for the year ended December 17 that that's gone up to a tax-adjusted trading profit of £100,000. Now, we've got the new agreement there. If you haven't got your notes from last time to hand, it would be a good idea now to pause and go back and find what was that old agreement that was in force. Because what we now see, given the information provided here, is that halfway through the accounting year ended December 16, here as you can see on the 1st of July 16, we have a change in the agreement. That means that for 6 months of the accounting period, the old agreement will be in force, and then from the 1st of July to the end of December, we'll have the final 6 months of that period using this new agreement here, splitting our profits between the three partners A, V and FC. Okay, Now, you should know how it is that we will now present our answer. Have all the information available to you, and then we need to set up our answer now to deal with the division of the adjusted trading profit, firstly of the accounting year ended 31st of December 16. And we need, of course, a total column, and the total tax adjusted trading profit for that accounting year end was £80,000, we are told. And we will then need a column for each of what will now be 3 partners that have been partners at some point anyway during that accounting period. So first of all, we look at the old agreement. Now that was in force from the 1st of January 16 through to the 30th of June 16. Remember that we had the new partner coming in from the 1st of July. So that means we've got 6 months worth of that profit of 80,000, i.e. 40,000, to divide using the old agreement. Now the old agreement, do make sure you've looked it up from last time, called for salaries, of course, to partners A and V, and as this accounting period here is at 12 months and we've got 6 months on the old agreement, we will take 6/12 of those salaries. They were £24,000 for each of partners A and V. So 6/12, half of 24, will be A credited with 12, V credited with 12, £24,000 therefore in total. So we've allocated with salaries 24 out of the 40, meaning that for our profit sharing ratio, look back, that was 3:2 between A and V, is now to be used to split out the remaining profit. I say the remaining because we're looking here to allocate 40,000. We've allocated 24, so 16,000 is that remaining profit. And that here is to be split between these 2 partners. Remember, this is before partner FC joined, in the ratio of 3:2. Now, get your calculators out and just check to make sure that I've got these numbers correct. But on my arithmetic anyway, I'll make that £9,600 and £6,400 respectively there. Just check to make sure that you are okay with those numbers. Again, 16,000 to be divided 3:2. 3 plus 2 is 5. 3/5 of 16,000 is hopefully 9,600. 2/5 there. Remember, 3 plus 2 is 5. 2/5 of the 16,000. Well, that therefore is going to be 6,400. Add down partner A for this part of the accounting period. What's that? 21,600. Partner V, 18,400. Crosscast, 18,400 plus 21,600. Yep, that is £40,000. And the old agreement, the first part of the accounting period, has now been dealt with. Right, on therefore to the period from the 1st of July, our new agreement, in force from the 1st of July 16 to the end of the accounting period, the 31st of December 16. Now that, of course, is also 6/12 of 80,000, and that therefore will again give us £40,000 to be divided. How do we divide that? Well, of course, salaries are first, and that again is going to be 6 months worth of salaries. The salaries this time, you will recall, were £20,000, £20,000 and £10,000 respectively. So half each of those, 6/12 of 20, 20 and 10, that's going to be 10,000, 10,000, and now partner FC is in here with £5,000. So 10 plus 10 plus 5 is 25,000. We're splitting out, as we see there, 40,000. That leaves £15,000 to be split in what is now the new profit sharing ratio of 3 to 2 to 1. Well, as we've just seen, what's the PSR? 3, 2, 1. Add up 3 plus 2 plus 1, that is 6. So 3/6 of 15,000 will be allocated to A, 2/6 to V, 1/6 to FC, giving us, therefore, then the ability to establish the remaining part, the final 6-month division of profit between what are now the three partners. So 3/6 of 15 is 7,500, 2/6 will be 5,000, and 1/6 will be 2,500. Again, just cross-cast, 7.5 plus 5 is 12.5, plus 2.5 is 15. Add down A, 17,500, V, 15,000, and then we've got FC with £7,500. What does that therefore give us for the accounting period as a whole, in which 80,000 was made for the accounting year ended December 16? We have got, well, we'll deal with the easy one first. Part FC there, who's just recently joined the partnership, has got 7,500. Partner V, 18,400 plus 15,000 is what? 33,400, methinks. And for A, 21,600 plus 17.5, 21 plus 17, that would be 38. 500, 600 is 1,100, so that's what? That's 39,100. Right, just check. What have we therefore got? 39,100 plus 33,400. 39 plus 33, 72. 72,500 plus 7.5. Hopefully there, you've got your calculators. I'm ridiculously trying to do this in my head. £80,000. So we've now got the division of the profits between the partners. 39,100, 33,400 and 7,500 for the newly joined partner FC. Now, a very easy exercise that I would like you to perform here is, having dealt with the accounting year ended 31st of December 16, I'd like you now to deal with the accounting year ended the 31st of December 17. Now that's entirely on the new agreement, so all of the 100,000 is split using one agreement. That's the one that we've got, with the salaries 20/20/10 and the PSR 3 to 2 to 1. So pause at this point in time, do that and get those figures. Now again, you'll see why I have asked you to do that when we then come to the final part of the problem, which is, having got the adjusted trading profits of each partner for each accounting period, then and only then do we try to determine the assessments for the relevant tax years. So sort out the year ended December 17 for me in the division of the £100,000, please. Do that, and then together we'll work the assessments for the relevant tax years. Okay, well, I left you with the task there of dividing out what was the tax-adjusted trading profit of the year ended 31st December 17 of £100,000 between what are now the three partners within the partnership. There's been no change in that agreement, therefore the whole £100,000 split on the one basis, the one profit sharing agreement, which was the salary levels between them, 20, 20 and 10, so some £50,000 in total there, leaving 50 of the 100,000 to be divided in that profit sharing ratio of 3 to 2 to 1. So again, 3 plus 2 plus 1 is 6. 3/6 of the 50,000 is £25,000 allocated to partner A. 2/6 of the 50 is, again, don't necessarily, as we've said before, expect all to be nice round numbers. 16,667, and 1/6 of the 50,000, 833. Add down for each partner, 45,000 for A, 36,667 so far as V is concerned, and then partner FC, 18,333. Crosscast, 18,333 plus 36,67 plus 45,000 there. Hopefully those three figures, I think yes, will come to £100,000. So you now know how it is that the tax adjusted profit of what is the year ended December 17 will be divided 45, 36, 667 and 18,333. Right. Having dealt with the two accounting periods and divided those tax-adjusted trading profits between the partners using the agreements in force during what were old and new parts, new arrangements, new agreements of the year ended December 16, and then entirely the new agreement on December 17, what we're now in a position to do is to work out the assessments for the relevant tax years for each partner. Now here, partner A and V are continuing partners throughout. Therefore, their bases of assessment will be the same. Continuing partners will mean current year basis. The more interesting partner, of course, is partner FC, who's joined the partnership from the 1st of July 16, meaning that with a start date of the 1st of July 16, his or her first tax year will be 2016-17, the 16-17 tax year. Right, let's just show what those assessments will now be. Now, we're looking at the numbers that we need to have actually on this page, because for A and V, we've got CYB assessments. Year ended December 16, CYB assessment is 16-17. Year ended December 17, CYB assessment equals 17-18. So for 2016-17, for 2017-18, each of partner A and partner V as their normal continuing partners will be assessed using CYB. So what was the adjusted trading profits that they had, firstly here, for the year ended December 16? Answer, £39,100 and £33,400. So for the 2016-17 tax year, for each of A and V, CYB assessments based on the year ended December 16, giving, as we've seen, £39,100 and £33,400. On to the 2017-18 tax year. Year ended December 17 is its basis period, and again we know CYB assessment applies for A, profit £45,000, for partner V £36,667. So for 2017-18, partner A using CYB is a £45,000 assessment to include in again his or her income tax computation for the 17-18 year, and likewise 36,667 to be included in the income tax computation for 2017-18 for partner V. So they are quite simple. They're CYB assessments for the years ended December 16 and 17. You know what their profit figures are. Those are what will be assessed. It is partner FC who is a much more interesting person, because as we've said with partner FC is a new partner, joining the partnership on, check back the dates, 1st of July 16. And for any new partner, we treat it as a new startup trade, and we assess using the bases of assessment that apply in opening years. So, like we did in Chapter 6, what was the start date for FC? The 1st of July 16. So the first tax year, 2016-17. What is the basis of assessment that applies in that first tax year? I hope we all recall, as it always is, actual. What do we mean by actual? We mean from this taxpayer, FC's start date, the 1st of July 16, through to the end of the tax year, the 5th of April 17. Now, so far as partner FC was concerned, started to trade on the 1st of July 16. That was within what was for the partnership the year ended December 16, but for partner FC, that was an opening period of 6 months, in which 6-month period, there you go, £7,500. That's the amount of profit that he made from the 1st of July to the 31st of December. £7,500. So, into our calculation now, we include the first 7,500, which is from 1st of July to 31st of December 16, plus we then want the next 3 months, which, so far as FC is concerned, is 3 months, taken what was for partner FC. He'd been a partner throughout the year ended December 17. It was a 12-month period. And for that year ended 31st of December 17, we had determined a tax-adjusted trading profit there for FC of 18,333. So we want going in now 3/12 of 18,333. Now you will need to put that one through your calculator to find out what that gives you. Now, when I did that a moment ago, I thought we won't trust that one to mental arithmetic, but I got that one to be 4,583. But do check just to make sure that my maths is right. So 7,500 plus 4,583, that therefore will take us to equals £12,083 as the assessment for 2016-17. Remember, FC joined the partnership on 1st of July 16. That's a start date in the 16-17 tax year. First tax year is actual, 1st of July 16 to 5th of April 17. As far as FC was concerned, he joined on the 1st of July of 16, first accounts to 31st of December. That was a 6-month period in which he made a profit of 7,500, all of which is in this tax year. We then want 3 months worth of his £18,333 there worth of profit for what was his accounting year ended December 17. 12,083 in total, methinks. On to then 2017-18. Right, basis of assessment in the second tax year. For FC, did FC have an accounting period ended in the 17-18 tax year? Yes, he did. He was a partner for the entirety of the year ended 31st of December 17. Now, because he'd been a partner throughout that full year, that means he's got CYB, current year basis, based on the accounting year ended 31st of December 17. Now, we're not including this as CYB just because there is an accounting year ended 31st of December 17. We're including it because partner FC started to trade on the 1st of July 16, so had traded throughout the year ended 31st of December 17. He or she had an adjusted trading profit for that period of, well, that I think was £18,333. So you now know that so far as partner FC is concerned, first tax year 16-17 actual, £12,083 assessed. 2017-18 his second tax year. He's traded throughout the year ended December 17, so it's CYB assessment 18,333. What it also means for partner FC, as we get in opening years, is an overlap profit arising. And what we can see is that all of the 18,333 for the year ended December 17 is assessed there in 17-18, but also 3 months worth of the 18,333, to be precise 4,583, had been assessed also in 16-17. So there, therefore, is your overlap. So we could also record overlap profits for partner FC of £4,583, to of course be deducted In deriving the assessment for FC's final tax year, should either the partnership cease to trade, or prior to that, should FC leave the partnership. That would be a cessation for partner FC. Okay. Hopefully, therefore, with a quick recap there, you'll be able to work back through and be happy with that, because if so, what I then want you to do is to work example 2. I'd like you, therefore, now to work example 2, where again we'll see Anne and Beryl have been in partnership since the 1st of July 14, making up their accounts to the 30th of June each year. On the 1st of July 16, Claire joins the partnership. Show the amounts assessed on the individual partners for all relevant tax years. For all relevant tax years. Now this is made a little bit more interesting, because rather than inheriting Anne and Beryl as an existing partnership and therefore using CYB, as has just happened with partners A and V, we're told that Anne and Beryl have been in partnership since the 1st of July 14. That explains why they give you what was fortuitously, because they made up their accounts to 30th of June each year, what was firstly an accounting year ended 30th of June 15. That means that for Anne and Beryl, 1st of July 14, the 14-15 tax year is their first tax year. Claire comes along on the 1st of July 16, that falls in the 16-17 tax year. For Claire, that will be her first tax year. So remember what we do. We don't try to work assessments for these tax years first. No, we look at each accounting year end and we look at the agreement in force during that period. It's a very, very simple basis. Profits are shared equally between the partners. Now, to begin with, there was just Anne and Beryl. That was the case for the year ended 30th of June 15, and it was the case for the year ended 30th of June 16, because very kindly here, Claire has joined the partnership on the 1st of July 16, which is the start of the year ended June 17. So it'll be simple calculations for you, therefore, to prepare. So, deal with each accounting period, get your total column, get your column for Anne, Beryl, and, where appropriate, for Claire. Divide out those profits. Once you know for each individual, Anne, Beryl, and Claire, what their adjusted trading profits are for each accounting period, then and only then can you attempt to work the assessments. Okay, so pause at this particular point in time, please. Work through that exercise, then check out the answer in the back, and then rejoin us and I'll quickly review that answer in the back for you. Okay, well, I trust therefore that you've performed the example 2, and I'm really hopeful that you've got answers that look pretty much the same as what we've got here. So what did we do? Remember, allocate the adjusted trading profits for the accounting periods, first of all, between the partners. Now, although it was a start-up for Anne and Beryl, we started with a full year end. Year ended June 15, as you can see there. Simple agreement, profits, losses shared equally, so the adjusted profit split equally, 6,000, 6,000. On to year ended June 16, split equally, 7,700. Claire joined at the beginning of the year ended June 17, that was the 1st of July 16, so that profit, 24,000, split equally, 888. So far as the assessments are concerned, as we agreed in our introduction to it, Anne and Beryl started on the 1st of July 14, making 2014-15 their first tax year. What is the basis of assessment we use? Actual. What is the basis period? Start date, we've already said, 1st of July 14, through to the end of that tax year, the 5th of April 15. Now, Anne and Beryl each had a profit of £6,000 for what was for them the year ended June 15. How many months of that are from 1st of July 14 to 5th of April 15? 9 months. So 9/12 of £6,000 is £4,500 to be assessed for 14/15. On to the second tax year, 15/16. More usually a problem in terms of working the basis of assessment, but not here, because we started on the 1st of July, prepared accounts to 30th of June. We do find we have an accounting period end date, the 30th of June 15, ended in the 15/16 tax year, and what is more, it's an accounting year end, and because it's a year end, we use CYB. What are those profits? Well, as we've already seen, £6,000, and that of course then gives rise to an overlap profit. All of that 4,500 is a part of that 6,000, therefore overlap profits of £4,500. Those will be carried forward by each partner, and should that partner leave, be it Anne, be it Beryl, or the partnership cease trading, the overlap profit is there, available to be credited back against what would have been the assessment in their final tax year of trading. We then continue with CYB, year ended 30th of June 16, assessed in 16/17, year ended June 17, assessed in 17/18, and pick up the respective profits of £7,000 and £8,000 each there. Claire, to finish it off, she started on the 1st of July 16. That was her start date, meaning, as we said, 16/17 was her first tax year. Actual basis, start date to following 5th of April. Now, of course, she started at the 1st of July, which was the beginning of the full year ended 30th of June 17, and her £8,000 of profit made for the year, of which 9 months are of course contained here within this tax year, and that gives us £6,000 to be assessed. 17/18, does partner here, what was her name, Claire, does she have any accounting period for which she's been a partner ended in that year? Yeah, it's the year ended 30th of June 17. Was she a partner for all of that period? Yes, she joined on the 1st of July 16, so for her it is a year ended the 30th of June, ended in the 17/18 tax year, so we can use CYB basis of assessment. And as we know, that's £8,000 of profit. We've already assessed 6,000 of that 8,000 in 16/17. There's your overlap profits, £6,000. Job done. The only thing that would make that exercise more difficult is what I did to you in my exercise earlier, our teaching one, where we've had changes in the profit sharing agreements during accounting periods, and of course we've had a rather more interesting profit sharing agreement where we've had both salaries and interest on capital to apply. Not the problem, however, here. Okay. It means we've just got one more lecture to deal with, hopefully relatively short, on our final session on this particular chapter, because having dealt with what happens when a new partner comes in, then we'll give you one more example, as there isn't one here, and what happens if one of the partners should leave the partnership. Now again, we'll continue with the example that we've had going with partners A, V and FC. We got as far as the year ended, I think, December 17. We'll roll that on for one more accounting period in our final session together. And we'll also look at, though you won't need to do calculations, it's just the concepts you need to be aware of for F6. What happens if the partnership makes a loss? What loss reliefs would be available, not of course to the partnership, but to each partner? And that we'll see in our final session together on this chapter next time around.